Welcome to This Explainer. Today, we're unpacking a massive shift that is heading straight for our wallets: central bank digital currencies. Look, whether you're deeply invested in crypto or you just tap a regular old debit card to buy your morning coffee, this shift is coming. By 2030, most people will likely interact with one of these systems. So we're going to explore exactly what they are, how they work under the hood, and what the broader implications are. And we're going to do it completely neutrally. Let's dive right in.
Okay, let's start by looking back at the 3,000-year history of money. Over that time, we've fundamentally upgraded how we pay for things 3 times. Back in 600 BC Rome, we finally stopped trying to barter stubborn goats and moved to coins. By 1000 AD in China, we evolved to paper notes, just to avoid lugging around heavy bags of gold. Then, in the 1950s, money went digital, meaning your bank balance simply became numbers in a database. And today, well, we are officially due for our 4th major upgrade, the Central Bank Digital Currency, or CBDC.
So here's our roadmap for today. 1. What is a CBDC? 2. How CBDCs actually work. 3. Why governments want them. 4. The crypto impact. And 5. Risks and rights.
All right, Section 1. What is a CBDC? Cash for the internet age. Let's start with the absolute basics. It is actually kind of staggering to realize that 97% of the money you use today, like when you swipe a card or use a payment app, isn't actually government money at all. It's literally just a digital IOU from your private bank. If that bank crashes, you're relying on insurance to make you whole. Only a tiny, tiny fraction of the money supply is physical cash, which is issued directly by the government and actually carries zero credit risk. Well, a CBDC completely changes that dynamic. It's a direct digital IOU from the central bank itself. It functions exactly like physical cash, meaning there's absolutely zero credit risk, and you don't even need a private bank account to hold it. But it lives entirely on your phone. It has the exact same issuer as the paper bills in your physical wallet. It's just built on completely new technology. Think of it like this. If physical cash is a paper letter mailed to you by the government, a CBDC is simply an official email from the government. It's faster, it's cheaper to move, and it's entirely digital. And just to clear up a super common confusion right off the bat, Bitcoin is entirely different. Bitcoin is like sending digital gold over email with no central issuer at all, whereas a CBDC is highly centralized and issued directly by the state.
Moving on to Section 2, how CBDCs actually work and the tech choices behind them.
So governments essentially have 2 main architectural choices here. The first is an account-based model. Think of it like a standard bank account that's linked directly to your national ID. It's great because if you drop your phone in a lake, the central bank can easily recover your funds. But of course, it's much less private. The alternative is a token-based model. Here, digital tokens live directly on your device. It offers really high cash-like privacy and can even work completely offline. But just like losing a physical leather wallet, if you lose your phone, that money is gone forever. In reality, most countries are building hybrid models to try and thoughtfully balance these pros and cons.
Okay, we actually need to bust a major myth right here. Central banks generally are not using public blockchains like Bitcoin or Ethereum. Why? Simply because public blockchains are way too slow for entire national economies. A central bank needs to reliably process over 100,000 transactions per second. Plus, they need a private ledger to maintain absolute central control over things like reversing fraud or freezing illicit funds. So they tend to use private centralized databases or highly specialized distributed ledger tech where the government runs all the nodes. Let's look at a real-world example to see how simple this is: Nigeria's e-naira. For a retail user, it's incredibly straightforward. Step 1, you just download the official app and link your phone number or ID to onboard. Step 2, you fund it by transferring money directly from your traditional bank into your newly minted central bank wallet. And Step 3, you pay by simply scanning a merchant's QR code. The central bank updates the ledger instantly, it settles in about 2 seconds, and right now there are 0 gas fees for the user. Pretty seamless, right? That brings us to Section 3. Why governments want them: payments and control. With the mechanics cleared up, we really have to ask the big question. Why are 134 countries suddenly racing to build these systems right now? Well, governments are heavily motivated by a mix of goals. First, massive financial inclusion. There are 1.4 billion unbanked adults globally. A CBDC allows them to use a basic smartphone as a bank account. Second, ending cash anonymity makes it vastly easier to track transactions, stop corruption, and prevent tax evasion.
Third, it grants central banks entirely new monetary superpowers. They can literally drop helicopter money directly into citizens' wallets during a crisis, or even apply negative interest rates to force immediate spending. And lastly, sovereignty. Governments saw tech giants trying to create private money, and they see the massive rise of dollar stablecoins. CBDCs are their core defense mechanism to keep strict control of their national currencies. Next up, Section 4, the crypto impact, specifically regarding Bitcoin and stablecoins. Now, while many people assume CBDCs are being built to just kill Bitcoin, they actually serve completely different purposes. A CBDC is designed to be stable, government-backed, and optimized for effortlessly buying your daily coffee. Bitcoin, on the other hand, operates with no central issuer at all. It has a fixed supply, making it a reliable inflation hedge, and it is entirely censorship-resistant. Honestly, in many ways, the rollout of highly controlled CBDCs will likely cement Bitcoin's narrative as digital gold, a place for long-term savings outside the traditional system, while CBDCs smoothly handle everyday digital payments. They're highly likely to just coexist.
And finally, Section 5, risks and rights. We need to look at privacy and surveillance.
This is crucial. The true superpower of a CBDC, and honestly the source of most privacy fears, is programmable money. Because a CBDC is purely digital, governments can literally write lines of code that dictate exactly when, where, and how your money can be spent. On the positive side, welfare money could be strictly coded to only buy food, or taxes could be auto-deducted directly at the point of sale. But on the flip side, stimulus money could be given a strict expiry date to force you to spend it quickly, or funds could be restricted based on carbon quotas or social behavior. Code is law, and the debate right now is fiercely over who gets to write that code. But remember, no two CBDCs are identical. A system's ultimate impact entirely depends on the laws of the issuing country. Nigeria designed the e-naira primarily to boost financial inclusion and deliver direct government aid. The European Union is designing the digital euro with intense legal focuses on preserving user privacy and explicitly avoiding programmable limits. Meanwhile, China's e-CNY is openly being tested with expiry dates and has ties to broader systems that tightly monitor citizen spending. The core technology is entirely neutral, guys. The government's intent is what truly matters here. So whether you view programmable money as a super helpful financial tool or a massive surveillance risk, experts heavily recommend protecting your personal financial autonomy. The absolute best defense, simple diversification. Keep some physical cash, hold some Bitcoin for long-term savings, and use CBDCs for daily convenience so you aren't completely locked into a single point of failure. Use tiered wallets, keeping small amounts in private, unlinked wallets if allowed, and always, always read up on your local laws regarding freezing and expiry rules. As we wrap up this explainer, I want to leave you with a crucial thought. We know for a fact that the future of money is digital. It's going to be faster, it's going to be cheaper, and undeniably more traceable. But as these massive networks roll out globally over the next few years, the big question remains, will it also be free? It's ultimately going to be up to us as citizens to pay close attention, participate in the legal process, and ensure that our digital wallets remain true tools of freedom. Thanks for learning with us today.